Okay, so let's finish earlier. You can go home earlier. So I think so far no problem for you guys. Finally, we finished the tables we need, okay? So I use my case on slide is page 112. So after finish the table, you have to understand what? For your first cost of borrowing, is your promise, right? So your promise is contractual interest rate. So the number should be the same, right? So how about total cost of borrowing, the second column? You'll find out the numbers will not be the same. Of course, because we based on what? Based on your liability. Your liability increasing each period. So based on your liabilities will not be the same. We times the market interest rate, of course, the total interest will not be the same. But what's our key point? Numbers, amount will not be the same. It's okay. But when we want to borrow money, we always have to meet market interest rate. So see, we use our market interest rate, what investors want, market interest rate, and try to figure out what's the interest we have to pay. So based on the market interest rate, so that's right. When we want to report our cost of borrowing, our interest on financial statements always is based on market interest rate, okay? So that's why we use effective interest method we just mentioned here. See? Why we use the second method, effective interest method, 有效利率法? Because after we finish the table, what's our true cost? Always market interest rate, because we base on market interest rate to get a number, okay? So when we report the true cost, always market interest rate, right here, okay? So of course the total number will not be the same, it's okay, because your liability is not the same each period. So the number here, total cost of borrowing, is vary. How about your second cost of borrowing? Of course, will not be the same, is vary. Okay? And how about your liability is increasing? Because of your second cost of borrowing, so it's increasing. Okay, any questions? No problem? Okay, so this is what the slide mentioned here on your 113. Here told you your amortization means your second cost of borrowing. And your interest, here we mention interest. It means your total cost of borrowing. Their numbers will not be the same. Okay, so that's what I just mentioned here. Your second cost of borrowing, your total cost of borrowing, the number will not be the same. They are vary over periods, okay? But our purpose is we want to know our market interest rate, our true cost should be always market interest rate, okay? So always we report market interest rate. That's what we want. Because that's the actual cost we have. And we want to report it on your financial statement. Okay, any questions? So you have to understand every time when you find out interest expense on financial statements, always is contractual interest rate or market interest rate. When you look at financial statements, find out interest expense, always is contractual interest rate or market interest rate. Market interest rate, okay? Okay. So if you're no problem, so let's look at how to record the situation. Each slide here, like this, market interest rate is your actual interest. And we report market interest rate on financial statement. So this slide's content, I already combined together in one slide, okay? So I finished the whole concept right here. So if you understand this, it means this slide, also it means this slide, okay? So after we find out our first cost of borrowing and second cost of borrowing, right now we are going to recall the transactions on accounting books. So this is our first cost of borrowing. We promise we are going to pay the interest each period. So that's your first cost of borrowing, right? So finally, we get our second cost of borrowing using effective interest method. We find out our second cost of borrowing for each period. So that's our purpose. We get the numbers finally. Second cost of borrowing each period. Using effective interest method. 有效利率法。Okay, so right now we are going to record our first cost of borrowing at the same time record our second cost of borrowing. Okay. So the whole process we call it what? Discount amortization. 折价摊销。Okay. No problem? Okay, so we are going to talk about our first cost of borrowing, second cost of borrowing. When we pay it? January 1st. January 1st, we pay our first cost of borrowing. Okay, at the same time, we recall our second cost of borrowing, but we didn't pay it. But the problem is, before January 1st, what happened? December 31st come first. So we are going to prepare financial statements, okay? So let's look at the first period. Before we pay it, we have financial statement first. So we have to recall this situation on December 31st. This is your financial statement date. So financial statement date, we recall what happened, right? But did we pay? No, we didn't pay. Why? Because you are going to pay next day. So January 1st, next date, we are going to pay it. But remember, you are going to pay it only for your first cost of borrowing. So this is your interest payment date. 利息支付日。But remember, for two costs of borrowing, first one is your contractual interest rate. Second one is your discount, right? We only pay the first one. Second one, we don't pay it until maturity date, okay? So that's why you just pay the first one. Next date, you pay it. How about your second cost of borrowing? We don't pay it. So for your second cost of borrowing, we didn't pay it. Okay? Any questions? So you have to understand, even though next day we just pay the first one, we don't pay the second one. Okay? So based on this, how we record the situation on financial statement date. So financial statement date, we record our two cost of borrowing. So how about your first one? No problem, right? What's a debit? What's a credit? Debit, interest expense. Credit, interest payable, right? So your debit interest expense occurred, interest payable occurred because you didn't pay. Why you are going to pay? Next date. So how about your second cost of borrowing? Since they are cost of borrowing, so we use same account, interest expense, to describe the same thing. So our second cost of borrowing, $324. So your interest expense increase $324 again because of your second cost of borrowing. So that's for debit. What's a credit? Bonds payable. Why? Remember why is bonds payable? Because when you look at your tables, we just mentioned here, your second cost of borrowing, you didn't pay. That will make your liability increase to maturity date. You have to pay principal. So your bonds payable, your liability increasing because of your second cost of borrowing, right? So we have to use the same account to increase your liabilities. So that's why credit, bonds payable. So credit, bonds payable. Because your second cost of borrowing, you didn't pay. Okay? So when you will pay at the maturity date. Okay? So that's why your liability increase. Any questions? So credit, you have to use bonds payable because that means your liability increase. Any questions? So you can record it separately. First cost of borrowing, second cost of borrowing. But I just mentioned before, when same transaction occurred at the same day, you can combine together, okay? So two journal entries, you want to save your time, you can combine together, become one, okay? So you can combine these two, become one. So when you combine together, interest expense, debit, for what? For your total cost of borrowing. Credit, Interest payable. Remember, interest payable, you will pay the interest only for first cost of borrowing, right? Then credit what? Your bonds payable. For what? For your second cost of borrowing, right? Because your second cost of borrowing, you will pay it at the maturity date. Okay, any questions? So that's it. That's when we have to record the situation. On financial statement date, you record the first cost of borrowing, second cost of borrowing. Okay? After we record it on our first accounting book and post to your second book. So our target is use the information to prepare financial statements, right? So what kind of information you can find out on financial statements? Okay, so on financial statements, remember, statement of comprehensive income, you can find out what? Interest expense, right? So that's your cost of borrowing, interest expense. But interest expense, remember, when we report on financial statements, we want to report our actual cost, right? So what's our actual cost? Market interest rate, don't forget. So the number always should be market interest rate. So market interest rate is based on your first cost of borrowing, right? So your first cost. So what's your first cost? Contractual interest rate. Plus, what's your second cost? Your discounts, right? For each period. Okay? So don't forget, on financial statements, interest expense, we mean actual cost. Actual cost, always market interest rate. So how to get a market interest rate based on your first cost plus your second cost? Okay? How about balance sheet? Balance sheet, we want to know our liability, right? So based on liabilities, we have two liabilities so far because it's December 31st. We didn't pay interest yet, right? So we have two liabilities. First one, interest payable. So what does it mean? Interest payable is the interest we owed. When we are going to pay? Next day, right? So you will pay next day. So that's why you should put it into current liability. Why? Because it's less than 1 year. So you will pay less day, so it's less than 1 year. So you have to pay, you have to put it into this section. So can you tell me $10,000 is for what? Your first cost, right? Now how about your bonds payable? Bonds payable is our long-term liability, right? Because you will pay when? After 5 years, right? So it's more than 1 year. So what's the liability we have? Based on the money you borrow at the beginning, then plus what? Your second cost, right? So your liability will be increasing because of your second cost. So liability at the beginning, $98,000. After one period, your second cost made your liability increase. Okay, any questions? Then how about next day? Finally, next day, we are going to pay interest back, okay? So interest, you are going to pay back for your first cost. So next date, your interest payment decrease, cash decrease on next date. Next day is interest payment date. Okay, you just pay the money for first cost. We don't pay second cost. Why? Because second cost you are going to pay at the maturity date. Okay, so not today, not each period. So your second cost will pay at maturity date. Okay, any questions? No problem? Okay, good. So you can finish the whole things by yourself. Please finish page 34, 35, and 36. Then you can go home. Record the whole process, whole transactions. So you just look at the data you have on page 33. Page 33 is all the numbers you have and trying to recall the whole situations on page 34, 35, and 36.